So first let me explain some of the primary rules about order blocks in the smart money concept. Basically, we consider the last candle that created the inefficiency as the order block zone, which we believe that the decisions are made during this candle. Sometimes order blocks are at the start of an impulsive move, and sometimes in the middle of the movement, in the form of a candle with the same or opposite color. We have 3 major rules for identifying a valid order block. First, it must create inefficiency. Inefficiency occurs when we have drastic moves that create gap between the shadows. These are examples of efficient and inefficient moves. Second, it must lead to a break of the structure or a change of character. A break of structure or change of character is the first clue that the market is telling us whether it intends to continue in the same direction or reverse. Third, it must be unmitigated. Order blocks are one-time use, so we only look for trading opportunity when the first time price taps into an order block. Here on the Euro-Dollars 15-minute chart, let's spot the order blocks starting from the left. These are the areas where we have clear inefficiency on the chart. So we mark the candles that created the inefficiency as our order block. If they lead to a break of structure or change of character, all of them consider valid order block according to our rule. Now let me explain the steps of the trading strategy we use for the backtesting order block. The rules for this trading setup are easy. Identify a valid order block. Place your order at the beginning of the zone and put your stop loss at the end. We target to times our stop loss range for the profit. This way, even with a 34% win rate, we will still be at break even. We have back-tested this trading setup 100 times on Euro-Dollar pair in the 1-hour time frame. For the back-testing, we use Trader Edge software, which allows us to save so much time while back-testing our strategy. We set our initial account size at $10,000 with 2% risk, targeting for percent profit. Now let me show you the results we have got. These are the 100 order blocks we have spotted on the chart. The green order block you see are the trades that hit our 1 to 2 and ended up winning. The red order block are the trades that ended up losing, and the gray order block are the ones the market did not trigger. And finally, we canceled the trade. So these are the backtesting results we have got. From 100 order block setup, 28 did not trigger, 41 ended up being a losing trade, and we have 131 setup. Our win rate was 43%, and we suffered a 10% maximum drawdown. Although our win rate was less than 50%, this trading setup raised our initial account size by 47%. In the backtesting, we have realized that when certain conditions order block, the chance of winning the trade significantly improved. We also noticed repetitive patterns form on the chart that dramatically increases trading return. So let me explain to you what conditions are required to identify a high-quality order block. But before we continue, as always, please smash the like button to show your support, since this video took a long time to make for our team. Also, if you have any questions, please ask them in the comments, since we do our best to answer all the factors that should be considered when trading order blocks are summarized in 4 categories, including market structure, market volatility and spread, market trends, and recent order block confirmations in lower time frame. Let's start with the market structure. Let me show you some of the most common market structure patterns that happen every day. Here we have a valid order block and a potential trading opportunity to go long. But looking at the left side, we can spot this gap between the candle precisely below the first order block and another valid order block zone here. Now there is a high chance for the price to come and fill the gap. Grab the liquidity below the first order block and continue pushing up when it taps into the second order block. So when this pattern is formed, and we have a gap and another valid order block precisely under the first one, we give the first order block -1 point for trading. Also remember that breaking below the first order block does not necessarily mean a reversal is coming, since there is a high chance that this break is just a liquidity grab for movement. On the contrary, look at the second pattern. Here we have a valid order block, and looking at the left, we can see that this move has swept the liquidity under these equal lows, which can fuel future movement. So when this pattern is formed, and we have an order block that grabs the under liquidity or above the equal lows and high, we give it a +1 point for trading. The third pattern is similar to the second one. Imagine we have an order block in front of the market. As the price approaches this level, it creates support, which retail traders put their stop loss under them. Hence, there is a higher chance for the price to grab the liquidity under the equal lows and continue moving to the upside when it reaches the order block zone. So let me show you some real chart examples to highlight the point. Here we have euro-dollar in a 1-hour time frame. We can spot this valid order block that created inefficiency and break of structure. But looking at the left side, we can spot the support that rejected the price multiple times. So there is a lot of liquidity gathered below this level. Also, we have gaps exactly under this and another valid order block. So there is a high chance for the price to break below this liquidity zone to fill the gap and continue pushing up when it taps into the second order block. Here is another example. You could have taken either of these as order blocks. We have a clear gap, break of structure, and a lot of liquidity gathered below these equal lows. And this mitigated order block. So once the price breaks below this higher low, some traders might take it as a change of character. But looking to the left side, we can notice a clear gap and a valid order block exactly under this level. So there is a higher chance that this move is going to be a liquidity grab. And we are still identifying this market is bullish. Now look at this bearish example here. In euro-dollar 1-hour time frame, we have an obvious downtrend. We can spot this order block that created inefficiency and break of structure. But the interesting point about this order block is that the start of this move is a liquidity grab. So this is +1 point trading opportunity. But here's an important point. Every time you encounter a losing trade, it does not necessarily mean that there was a in your analysis. Remember, no strategy always works because we can't control the market. The second factor you should consider when trading order block is the market volatility and spread. When we analyze the backtesting result, we notice that most winning trades happen on the highly volatile session. Usually on the first and last day of the trading week, the market suffers from low liquidity. That is why the majority of winning trades happen in the midweek also. A pair like the euro-dollar is best to trade during the highly volatile time of the day, such as London and New York sessions. Otherwise, trading won't make sense because we will not witness the movement we want to see in the market. Another important factor in trading is how to deal with the spread. Many times, the market reacts to order blocks within a pair. So having a high spread will make you miss many winning trades or trigger the stop loss when the price did not even touch it. The third factor influencing the success of order block is the market trend and their freshness. Order blocks have a higher success rate in trending market than in the ranging scenario. So as a result, it is better to trade the order blocks that are in the direction of the dominant market trend. Also, trading recently printed order blocks are more effective because the market constantly changes direction, and spending too much time waiting for the price to tap into the order block often leads to a losing trade. Since the demand and supply are constantly fighting to take control, trading fresh order blocks have higher win rate. Here on the euro-dollar, when we have a clear trending market, see how often the market prints fresh order blocks, rejects them, and continues pushing up. On the contrary, look at another example. Here we have a valid order block zone, but before price taps into this area, market have made a lot of demand and broke them to the downside. Some traders might take these areas as liquidity and put their buying positions on the order block, but the point is that the supply has taken control, and trading this order block without confirmation won't be effective. So that is why the confirmation in the lower time is the third factor you should consider when trading order block. Confirmations save us from a lot of unnecessary loss when the market decides to ignore the order block. Also, having a solid entry reason as confirmation in our trading arsenal makes us trade more confidently. The order block's trading strategy is not limited to any time frame. Still, after we spot the order blocks in the higher time frame, we zoom into time frames low to look for confirmations and trading entry. So when we use for our 1 hour and 15 minutes chart as our higher time frame, we look for entry reasons in 15 minutes, 5 minutes, and 1 minute respectively. You could use multiple price action setups as confirmation for trading the order block. Here are some of the most common patterns. We trade in the market. In the first step, we wait for the market to mitigate our higher time frame order block and for price action to show its next move. Now, the first thing we are waiting to appear is a change of character. A change of character signal that the short-term downtrend is over and the price can start to move to the upside. So after the market makes a change of character, that is when we look to execute our trade. Usually, we witnessed a common pattern, and this is the way we place our order. The first pattern is when the change of character creates inefficiency and a valid order block. So we place our order a spread size above the order block and put our stop loss a couple of pips below the lowest point of the zone. We use a simple technique for taking profit to catch big risk to reward ratio without even experiencing much tension. If we end up being right and the price starts pushing up, we will reposition our stop loss under the market structure every time market makes a new higher low. This way, we could let our trades run in profit until we reach a higher time supply zone and close the trade. The second pattern happens when we have a change of character, but there is no inefficiency or gaps between the candle. So we place our trade with 8 of retracement level. We put the retracement tool from the start of the change of character, move to the end, and place a buy order in the middle of the 6, 1, 8, and 6 retracement level. Our stop will be a couple of pips below the swing low and target the next level of structure in front of the price. Remember that these trading setups are not limited to any time frame or a pair still. You must do your back test and see which pair is most suitable for these strategies. So guys, if you have enjoyed this video, please give it a thumbs up to show your support. If you are new, and subscribe to our channel. Thanks for watching and see you in the next episode.